You have embarked on a pretty aggressive path. You've done 250 basis point hikes. You've raised the height of the ultimate rate you think you're going to have to get to. So this is all in order to get demand and supply back in balance. You're going to keep raising rates till demand is low enough that supply will be enough to meet it. How aggressive are you willing to be? Are you willing to tolerate higher unemployment if it gets to this? If it means slower growth, bordering on something that raises the risk of recession?
Yeah, great question. And really the important part to remind viewers is, we are talking about a slower growth rate. We're not talking about bringing the level of activity down. And so growth versus levels is always important. We do forecast that unemployment will rise, but we actually see that employment growth slows below the pace of labour force growth over the forecast. So it's not one of those currently in or out of jobs. It's about the employment growth becoming more attuned to the labour force growth. I can't overemphasise the constraint on productive capacities at present in New Zealand because of the lack of labour supply.
Governor, it's interesting as we talk to economists and get reaction to this, we're finding out that there's a number who don't think you're going to have to get up to 4% on the OCR, the official cash rate. They think maybe the peak is much lower, 3.5%, maybe even not quite that high, because they think the economy, you're going to be successful. The economy is going to start cooling down, and you're going to be able to back off these rate hikes. How do you respond to that view?
That is a very plausible outcome. That would mean that we have to do less work to get the same outcome we're after, which is to have inflation return back to that 1% to 3% target range. Likewise, there's plausible stories where inflation expectations become unanchored and more persistent. And that means there's even more work to do for us in the future. So we need to balance those two stories. Our central projection is one where we achieve our inflation with interest rates only being modestly above what we would consider a neutral level, and holding it there, for a relatively brief period, really, over the next 12 months or so. And then over time, as we get that better balance, we can take interest rates more back to neutral. The biggest thing that has changed in recent times is our own risk appetite. We are becoming. We believe that the worst outcome, which we most want to avoid, is one where inflation expectations become persistent, and that means that we have to, slow demand considerably and have unnecessarily high unemployment to get inflation back to that level. We'd far prefer to do what we're doing now, a significant stitch in time, to avoid that process of having done too little too late.
Well, since we're talking about least regrets, I love that phrase, avoid the worst possible outcome to get a better outcome, much better. You've done 250 basis point rate hikes. Just have to ask, because I think all central bankers are getting asked now, if they've done 50, would you be willing to do more? Has that been discussed, certainly after you did the first 50 basis point rate hike and got ready to do the second one?
Yeah, so we've painted a pretty clear picture that, we want to move at pace and to a level of around 4%. It does give us time to stop and breathe and observe the data as we go. So, I can't commit to exactly what we'll do by when. We need to see the data like everyone does. But our best intentions are at least, so there's some more 50s and 25 movements. You can plot, a combination of possible steps. But we will start from scratch each time, every 6 weeks. We look at the data, how is it performing relative to what we were anticipating, and then recalibrating what we need to do. We've got time. It's a repeat game.
Mm-hmm. So with all the front loading that you've already done, 175 basis points since October, does that mean from any point from now onwards you could sort of take a pause? We'll be talking about the Fed, thinking about the Fed pause. Is that what you talk about when it comes to recalibration and looking at that data?
Yeah, I think we need to be careful with the phrase front loading. because we started from somewhere that was exceptionally low, exceptionally stimulatory. This is global interest rates. And what we're doing is trying to at least get it back to where it's neutral at the wholesale level. And we know we will have to now, with confidence, that we have to be leaning against demand growth. So, I wouldn't get too excited about how front-loaded we have. We've been very fast back to the start line, and now we are leaning into the inflation pressures we see. And, of course, we would take pause. We will always take on new information. We always need to stop and be considered and deliberate with our actions. And at the moment, we feel we need to go at pace.
Especially given that your latest statement is laced with references about global uncertainty, I wonder for New Zealand how specifically that is to do with what's happening in China, your largest trading partner.
Yes, that's right. I mean, we have a very standard consensus type forecast outlook for the international economy. We know the balance of risks, they're still, I would say, asymmetrical. They're still really, really challenged. Actually, you can have very quick resolutions to some of the issues that are currently challenging the globe around food and energy prices, or you can have a very persistent, drawn-out period of inflation. For us, China, it's the latter. A slower than planned economic growth really does impact New Zealand's international trading position. One of the benefits we have is our exports to China are often made up of final consumer goods, particularly food. And so that's not an intermediate good to be sent on, it's to be consumed there in China. So, we have a really reasonably robust trade, but we are concentrated to China. And I believe China's economic outlook is one of the more risky, harder to call growth rates out there at present.
Governor, it's yesterday at the press conference, you noted that the OCR is just at neutral now, around 2%, and that what you've done is you've moved the cash rate up to the point where you're consistent with market rates. Okay. Now, if you keep raising the OCR, which you clearly are going to do for a while, do you expect the market rates to kind of go stepping up with that? Or do you think as you become more restrictive with those rate hikes, do you think that the market rates are going to slow down and that gap is going to narrow?
Yeah, I mean, in an ideal world, if I was allowed to choose between those two options, Kathleen, it would be the latter option without doubt, because it would mean the markets are starting to be really challenged around whether we do need to lift the rates as far as we project. It brings in a healthy two sides to the market. What I want to leave no doubt about is what we are trying to target and achieve, and that is low and stable inflation over the horizon. If that credibility can be anchored, then of course you would expect an inversion in the yield curve. You would expect to see lower, longer-term interest rates than the near-term ones, meaning the markets are saying, hey, you've probably done enough to get over and on top of this inflation environment. We saw the yield curve flatten yesterday. That is in part that story that I'm telling you, but there's plenty of water to go under the bridge yet.
I want to ask you, too, you've also stressed a lot in the monetary policy report at the press conference how big a factor global forces, global inflation, global upward price pressures are. So with particularly looking at the Fed, if the Fed is more aggressive and the Fed starts bringing down inflation, does that allow the RBNZ to potentially do more with rate hikes? And conversely, if the Fed has to keep going more and be as aggressive or more aggressive than it's been, does that mean the RBNZ too is going to have to do more?
Yeah, so I think over the period that matters to us, the more work that other central banks do on behalf of global inflation, the easier the job is for us. It's a job shared. And without doubt, it's, we're seeing the US Fed, the ECB, all of the major economies really are moving in the same direction, other than China, around tightening monetary conditions, and we've seen financial conditions tighten. That all helps our case over the medium term, lower imported inflation, all of the activity. In the near term, and what we've seen, though, is that as the US interest rates go up, We see the interest rate differentials between New Zealand and the rest of the world narrow, and you see downward pressure coming on the exchange rate. Now, that has been the case across all countries. Everyone has eased their currencies relative to the US through that period. Those are very short-term dynamics that we just have to be aware of. We can't do anything about it. That's what it is. But that medium-term one, the more work by the US Fed, the bigger the problem is shared and the easier it is for all of us.
Governor, how worried are you about the impact of, at least for the short term, we're seeing higher borrowing costs and higher prices for households? And I know you've downplayed the risk of a recession, at least over the coming quarters, but is the risk of emerging stagflationary factors one that you're watching?
So just on the one, I mean, an enormous proportion of New Zealand mortgage holders are repricing their mortgages over the next 12 months, effectively starting now. So they will be shifting on to a different interest rate level. But the vast bulk of households, struck their mortgage well before the last 18 months, 2 years. And so a lot of those mortgages will be moving across from rates relatively similar to where they are onto these rates. And these rates are the ones the banks have been testing their consumers at. So I'm confident around the robustness, on average, of the New Zealand household sector to manage higher interest rates. But there will be pockets where high indebted recent borrowers will need to be readjusting their spending desires and priorities, without doubt, on that side. So that's that's what gives us the confidence. We're also the prudential regulator here in New Zealand, so we've got very good insights into the banks' behaviours and household balance sheets in that story. That's at least on average through time. That we hope. Right. On the recession side, that's not a central projection for us. We have small real growth rates on a persistent basis quarterly, but as we all know, a 0.3 growth rate is within standard deviations either side of, a negative or a positive. 2 negative quarters in a row is technically a recession. That sits within a confidence interval, but it's not our central projection.
Governor, final question. As you walk this rate hike path, you and your colleagues, is there one main thing? Are there a couple of main things you can tell us that you're watching to say, whether the key rate peaks out at 3.5% or goes all the way to 4%? What are the main signposts to say, hey, looks like we've done enough, we can pause, and maybe at some point even start thinking about lowering rates?
Yes, a great question, because as we know, whatever we do today, the end outcome's not for another 12 to 18 months ahead. So we can't just keep going until we see actual inflation fall. We'll be looking at aggregate demand and all the spending variables to see if they are slowing up in growth rates. An important sector of contributing to growth here in New Zealand has been the construction sector, so we'll be watching carefully as that evolves. But for us, it can be summed up so easily around inflation expectations. What are people thinking about where inflation will be 2 years ahead, 5 years ahead? We want that to remain anchored. If they start drifting up with current inflation, that's when we get concerned.